Operating cash flow, often abbreviated as OCF, is a term that might not roll off the tongue as easily as net profit, but let me tell you, it's the unsung hero of financial metrics. While net profit gets all the glory, operating cash flow quietly does the heavy lifting when it comes to assessing a company's financial health and sustainability. You see, many people assume that if a company is profitable, it must be doing well, but that's not always the case. Profitability is important, sure, but it's only part of the story. Operating cash flow digs deeper, revealing how well a company can generate cash from its core business activities to pay bills, invest in growth, and meet obligations. So, what exactly is operating cash flow? At its core, OCF is a measure of the cash generated by a company's regular business operations. It's a key player in the cash flow statement, which details the cash inflows and outflows over a specific period. What's crucial to understand is that OCF focuses solely on a company's operational activities, leaving out the cash flows from financing and investing activities. This is where it gets interesting. When you look at OCF, you're getting a clearer picture of how a business is doing on a day-to-day basis. Now, let's break down the relationship between operating cash flow and profit. While both metrics are vital for understanding a company's financial performance, they come from different angles. Profit includes non-cash items like depreciation and amortization, which do not impact cash flow. That's right, profit can look great on paper, but if a company isn't generating actual cash, it might be in trouble. OCF, on the other hand, looks at the cash that's actually coming in and going out. It considers the timing of cash flows, recognizing when cash is received or paid, rather than when it's recorded in the accounts. This is crucial because it highlights discrepancies that can arise from accrual accounting, where income and expenses are recognized even if cash hasn't changed hands yet. Let's dive into why OCF is so important in financial management. First and foremost, it provides a robust assessment of operational health. A positive operating cash flow indicates that a company is generating enough cash to cover its day-to-day expenses and invest in future growth. On the flip side, negative OCF can be a red flag, signaling potential financial distress. Next, OCF plays a pivotal role in evaluating a company's liquidity and solvency. Investors and creditors closely watch this metric to gauge whether a company can meet its short-term obligations. A healthy OCF means that a company can cover its immediate financial needs without having to rely too heavily on external financing. This is critical because if a company can't manage its cash flow effectively, it risks running into trouble when it comes time to pay bills or invest in new opportunities. Effective cash flow management is another key aspect where OCF shines. It provides insights into the timing and amount of cash inflows and outflows, helping management make informed decisions about everything from inventory levels to credit terms. Imagine a company that has a great product but is struggling to manage its cash flow. If they don't have a clear picture of their operating cash flow, they might find themselves in a bind, unable to pay suppliers or invest in marketing. Investors also love to look at OCF when making decisions. The positive operating cash flow suggests that a company can generate cash internally, reducing its reliance on external financing. This can lead to higher shareholder value and a more attractive investment opportunity. Plus, financial managers can use historical OCF data to forecast future cash flows, aiding in strategic planning and budgeting. Understanding OCF trends allows businesses to adapt to changing market conditions and make proactive financial decisions. So, what are the components of operating cash flow? Let's break it down into inflows and outflows. On the inflow side, we have sales revenue, which is the primary driver of cash inflows for a business. This includes the total income generated from selling goods or services. Then there are collections from accounts receivable, which represent the money owed by customers for credit sales. Efficient management of accounts receivable is crucial for maintaining a steady cash flow. Other cash inflows might include interest income or royalties, but these are typically less significant than sales revenue. Now, let's talk about outflows. The biggest outflow component is the cost of goods sold, or COGS, which includes all the direct costs associated with producing the goods or services a company sells. Next, we have operating expenses, which encompass everything from salaries to rent and marketing costs. Payments to suppliers and vendors also fall under outflows, as do operating taxes and interest payments. These outflows are critical to consider because they directly impact the net cash generated by a company's operations. Calculating operating cash flow is straightforward, but it requires some adjustments to net income. The formula is simple. OCF equals net income plus non-cash expenses minus changes in working capital. You start with net income, which you adjust for non-cash expenses like depreciation and amortization. Then you account for changes in working capital, which reflect variations in current assets and liabilities. By subtracting these changes from the adjusted net income, you arrive at the final OCF figure. The positive OCF indicates that the company is generating enough cash to cover its expenses and invest in future growth. Conversely, a negative OCF can raise red flags about a company's ability to sustain operations. Now, let's explore why understanding operating cash flow is so crucial. One of the main reasons is the distinction between cash and accrual accounting. While net income is derived from accrual accounting, which includes various non-cash items, OCF focuses on actual cash transactions related to core business operations. This distinction is vital because it aligns financial metrics with real cash flows, offering a clearer picture of a company's financial health. OCF is also a key indicator of liquidity and operational stability. It captures a company's ability to meet short-term obligations with available cash. A positive OCF indicates that a company can cover its day-to-day expenses and invest in growth opportunities, which is essential for maintaining operational stability. Moreover, OCF directly correlates with a company's ability to meet short-term obligations. By focusing on cash generated from core operations, OCF assesses whether a company has the financial capacity to cover its current liabilities without relying heavily on external financing. This is a critical insight for creditors and investors alike, as it indicates whether a company can sustain its operations without facing liquidity constraints. Interpreting OCF trends is also essential for stakeholders. Positive OCF is generally a good sign, suggesting that the company is generating sufficient cash to cover expenses and invest in growth. On the other hand, negative OCF raises concerns about a company's financial health. Analyzing trends over time can reveal valuable insights, such as whether a company is consistently generating cash or facing challenges that need addressing. Comparing a company's OCF to industry standards provides additional context. Understanding typical OCF values within the industry allows for a comparative analysis, shedding light on areas where a company excels or faces challenges. But let's not forget the pitfalls of relying solely on profit. Profit can be misleading due to non-cash items like depreciation. Timing differences can distort the financial picture, making it seem like a company is doing better than it actually is. Profit also doesn't account for cash flows from financing and investing activities, which can lead to an incomplete understanding of a company's overall financial performance. In conclusion, operating cash flow is a vital financial metric that offers a more accurate representation of a company's cash generation from its core business activities. It provides insights into liquidity, operational efficiency, and the ability to meet short-term obligations. By understanding the distinctions between profit and cash flow, stakeholders can make more informed decisions about a company's financial stability and potential for long-term success. So, the next time you hear someone rave about net profit, remember to give operating cash flow the recognition it deserves. It's the compass guiding businesses through the complex waters of corporate finance, ensuring they stay afloat and thrive in the long run.